Being a successful investor requires a combination of knowledge, strategy, discipline, and a lot of patience. So, today in this video, we are going to discuss some strategies which will help you become a successful investor. Let's get started. The first step is to educate yourself. As Mr. Warren Buffett says, never invest in something you don't understand. So start learning about the markets, learn how to analyze a company. Learn about different types of investments and the markets in which they operate and how they really work. Take the help of books, videos, articles, etc. to increase your knowledge. Understand the risks and potential returns of each investment. Also, knowing your risk appetite is curtailed, which is simply knowing how much risk you're willing to take, and stay up to date on economic and industry trends as they decide the movement of the market. Set investment goals. Determine what you want to achieve through investing and set specific, measurable goals. For example, are you saving for retirement, a down payment on a house, or a child's education? Your investments should depend upon your goals. Also decide the time duration of your investment by looking at your goals, and then only you should invest. When setting investment goals, it's important to be specific and measurable. It's also important to be realistic about your goals and the time frame within which you hope to achieve them. It's also important to review and adjust your goals periodically to ensure that they still align with your current circumstances and financial situation. Develop a diversified portfolio. Developing a diversified portfolio is an important step in becoming a successful investor. Diversification can help to minimize risk by spreading your investments across different asset classes, sectors, and geographic regions. Spread your investments across different asset classes, such as stocks, bonds, and real estate, will minimize risk and maximize your chance of success. The most efficient way of diversifying your portfolio is by doing it on the basis of your age. If you are young, you can take risk and should consider investing more in the stock market, which can give much better returns than other assets. But older people should prefer more stable assets like real estate, gold, and government bonds. These are least volatile and comes with no risk. Invest for long term. The markets can be volatile in the short term, but over time, they tend to move upward. By maintaining a long-term perspective, investors can avoid making impulsive decisions based on short-term market fluctuations and instead focus on their long-term investment goals. Investing in a diversified portfolio of assets and having a well-defined investment plan can help an investor to maintain a long-term perspective. It's important to remember that short-term market fluctuations are normal and are a part of investing. Rather than trying to time the market, it's better to focus on buying quality investments at fair prices and holding them for the long term. It is essential to remember that investing is a process and it takes time for investments to grow and compound. By staying invested for the long term, investors can benefit from the power of compounding and reap the rewards of their investments over time. Regularly reviewing and rebalancing your portfolio is a good practice to ensure that your investments align with your goals and risk tolerance. This can help you to stay on track towards your financial objectives and make any necessary adjustments to your portfolio to keep it balanced and diversified. It is generally recommended to review your portfolio at least once a year and make adjustments as needed. When reviewing your portfolio, you should consider the current allocation of assets and determine whether it still aligns with your goals and risk tolerance. This includes evaluating the performance of individual investments and the overall asset allocation of your portfolio. If the portfolio has become too heavily weighted in one asset class or investment, it may be necessary to sell some of those holdings and redistribute the proceeds to other investments to restore balance. It's also important to remember that rebalancing your portfolio doesn't mean you have to make major changes. But you always should keep an eye on the stocks and observe any fundamental changes which could create a problem for the company. That's all for this video. Hope the video was helpful and you learned something new. Drop a like and consider subscribing for more videos like this. Thank you.